So, all right, well, good morning and welcome to today's panel, NPC 20, Growth Hacking Secrets of PAYFACS and ISVs. I'm Bruce Shirey, SVP of Amaryllis Business Solutions, and I will be today's moderator. Just a little bit about Amaryllis. We provide an enterprise-level technology stack and infrastructure specifically designed for payment facilitators, marketplaces, and FIs and others to license and private label. And really what that happens is it allows the go-to-market faster with a lower CapEx, the way you get a secure and compliant platform without having to build one. So today's panel will be valuable insights into the arena of payment facilitation. And at the end, the audience will be able to pose questions and the panel will answer them at the end of the discussion. So next, I'm going to ask the panelists to quickly introduce themselves and their company and how they support this complex ecosystem of commerce and payments. Austin?
Thank you, Bruce, and thanks to everyone at Mobile Payments Conference for putting this on. My name is Austin Lewis. I'm CEO and CFO of both Paid.com and ShipTime.com. Paid is a platform that we refer to as an e-commerce as a service platform that allows small businesses to bring all of the tools that are associated with running a small online business together into one seamless platform. Those include a website builder, a CRM and email automation platform to contact all of the customers you may have, a shopping cart platform, payment facilitation platform, as well as a shipping aggregator so that you can leverage all of the options that are out there to get products to your customers. And then all of that, that platform ties in with your taxes and your accounting system to provide the information that you need to run your business in a seamless way. All of these products are connected through a single sign-on platform and fully secure, which allows you to kind of run your business and allows you to focus on with us being in the background as your outsourced IT and support team. That seems to be top of mind today as small businesses are struggling, and we're able to save them a tremendous amount of time and effort on the back end. And this allows small businesses out there to focus on what they really need to focus on in order to grow their business in terms of what products they want to sell and how to attract the right audience to their website so that they can convert and grow their business.
Thank you, Austin. Caroline?
My name is Caroline Helmuth, and I am managing partner of RPY Innovations. We are a consulting company, and we focus on assisting acquirers, ISVs, ISOs, and technology companies who want to build out their payments operations. Most of them these days are tech firms who want to become payment facilitators or take on the responsibilities of monetizing their payments in a seamless way. We assist with policies, preparation of all the operations, all the processes that essentially turn a policy into something that is actionable. We have a training team that makes sure that your employees are meeting all the AML, UDAP, and Code of Ethics, Antitrust, Fair Competition requirements that are now a part of all the regulatory requirements of being a payment facilitator. We have done 150 some odd projects at present all over the world. And I come with 30 plus years in payments. It's been a real privilege to be a part of the growing dynamic scene of payments. And we started seeing tech firms go toward payment facilitation, probably a little before 2009 when the regs started allowing companies to take on these responsibilities. We also work with a lot of ISVs who want to look at the model and decide whether or not it's right for them. And so the very first thing that we do is a financial analysis so that they can understand what their profitability and pricing models would be should they want to look at this model before they take on all the obligations. So that's who we are, and it's a real privilege to be a part of this discussion. And that's it.
Thank you very much. Ryan?
Yeah, thanks, Bruce. Good morning, everybody. My name is Ryan Edwards. I'm a Vice President of Business Development for Wells Fargo's Service Provider team. I support ISOs, payment facilitators, and marketplaces for the bank. I've been in payments and technology for a little over 15 years now. I truly love what I do at the bank. You know, I tell this story all the time. Early in my career, I sold to restaurants. And, you know, I think this is very relevant in the space where, you know, in merchant as a whole, merchant can be looked at as a commodity. And I've lost merchant accounts over $50 a month over perceived savings. I'm sure a lot of people in the audience, I can see you guys are laughing right now because it's so true. You know, one specific merchant that I remember, it's probably 11 years ago or so, there's a restaurant in Ohio, and this restaurateur came to me and said, "Hey, Ryan, I can save $50 going to XYZ Merchant Services." And I ultimately lost this opportunity. And you fast forward to now, that same restaurant is using a point of sale vendor that is operating as a payment facilitator. And the funny thing is they're spending 1% more on their merchant services than they did 11 years ago when I was trying to earn the business. And like many others, that POS vendor has really changed the ecosystem. Operating as that payment facilitator, they've changed the buying pattern of the merchant to where it's based on the software and not the merchant services as a commodity. Wells Fargo, like Caroline, we were early adopters in supporting payment facilitators. We've developed an amazing team to support ISOs, payment facilitators, and marketplaces. So really look forward to today's discussion and questions from the audience.
Great, thank you, Ryan. Let's get started. So today, there are many companies looking at the possibility of becoming a PayFac. The journey of becoming a PayFac includes a variety of unique and complex business processes, compliance standards, payment acceptance requirements, and more importantly, investment. I'm going to ask each panelist 2 questions, and then at the end of those 2 questions, the panel can provide additional context accordingly. So let's get started. Austin, within the universe of payment facilitation and SME marketplaces, you call yourself an e-commerce as a service platform. Why?
Thanks, Bruce. So in terms of evaluating the e-commerce landscape today, I'll use an example. We have some customers that have 20 to 30 different e-commerce plugins. And when you're dealing with, as a small business, with that many different vendors providing different solutions to your overall e-commerce landscape, it can really become a challenging effort. You know, our goal as a company is to, you know, work very closely in a partnering way with our clients so that they feel like we're providing, you know, true business support, and we refer to it as business continuity. We've been in various different situations as a software supplier where we get calls from our customers thinking that you know, our software had something to do with their system crashing. The unfortunate part of that, Bruce, is that particular merchant is going to have to call 40 different software providers in order to try to figure out where the hole in their boat actually lies. That can be a real challenge for small businesses that just don't have the IT budget or the folks to you know, focus on making sure that they have a platform that's going to have, you know, optimal uptime, and they can focus on growing their business. So for us, it's a real great opportunity to share with our merchants the value that we bring relative to supporting them in their business and trying to grow their revenue. So that's the real value of the e-commerce as a service platform. Is not just the fact that we tie all the components of e-commerce together in one simple, you know, all-in-one platform, but we actually are there to answer the phone when customers call and have a challenge around some part of the system not working together. When all of the components of your platform are under one set of code that works together, then we can very easily pinpoint any possible issues you might be having and quickly fix it. In today's digital world, anytime your site is down, that's an opportunity for you to lose a sale. And it's really unfortunate for those that don't have the right setup and can't be always up and available for their customers when they're willing to, when they're wanting to transact with you as a merchant. And as people are learning over and over again, people shop online when they have the time to do it, and that might be at 2 a.m. or it might be in the middle of the day. But regardless of when that's happening, small businesses need to be available and ready to take those orders and then handle the customer service associated with that. And so with the paid platform, the goal and the vision is to be able to support all small businesses in their effort to do that and grow their business, so they can focus on what's important to them and let some of the items in the background kind of fall to us as their partner in technology.
Some really comprehensive planning and thinking you put into that. So the next question is it fair to say paid's business continuity strategy, for example, data-driven e-commerce and hosting purchases through fulfillment and delivery, lowers the overall merchant operating costs and helps prevent disenfranchisement of your merchants and their customers because of the seamless and the frictionless experience that your organization is providing?
Yes, I think that's accurate, Bruce. We've built a platform that is leveraging lots of different components so that we can deliver a solution that customers expect. And there's been numerous scenarios where we've heard stories from merchants where their systems are down and they really have no response to their customer. And it's really challenging in today's times where small businesses are spending millions and millions of dollars to acquire the perfect customer. And then once they've actually got that perfect customer on the hook, they fail to deliver in terms of the service and the product that their customers are expecting. So with our platform and our solution, tying everything together in a single sign-on fashion, where you can go back and forth between the different modules without kind of logging in and logging out to all the other possible software combinations that you may have put together. This really provides not only an easier platform for the merchant to use in terms of supporting their customer, but you can also provide much better customer service, because if there's ever an issue, you know exactly where that lies. In terms of paid providing support to the merchants, it's equally important, because we can do that in a much more cost-effective way, and we can pass that cost savings on to the merchant in terms of them operating their business in an optimal way.
Definitely making a nice change to the e-commerce and the user experiences. It's well timed. So Ryan, Caroline, do you have anything you'd like to add on?
Yeah, I've got two comments. Like, I think one with companies like Paid coming into the market, Austin's point, having that single point of contact, it creates an easier environment for a merchant to operate. It's similar with that finger pointing where you look at, a lot of cases with ISVs, where an ISV will partner with a payments company and say, hey, that's a payments issue, or hey, that's a software issue, and there's finger pointing back and forth. So having that single point of contact is really important. But also the control over the customer experience. I think you'll hear me talk about this all the time, is the control over the customer experience is by far the most important. And consumers and merchants are willing to pay more for that convenience, really. I use an example with Amazon all the time, where I think it was like 2 years ago-ish, like May of 2018, somewhere in there. If I did a poll right now, if I could see everybody in the audience, and asked who had Amazon Prime, I would assume the majority of people would raise their hand. And if I did the same poll asking in May of 2018, when Amazon raised their prices by 20% for Amazon Prime, I would likely bet that the majority of people would not raise their hand that they canceled the service. Because there's value behind what Amazon's doing, that single point of contact, that convenience that you're able to shop at 2 a.m. in the morning. It's that convenience and control over the customer experience that Austin was mentioning.
Good. Caroline, would you have to add anything?
I agree with you. One of the things that we've noticed about the consideration of ISVs toward payment facilitation is how much control do they have over the customer relationship. That seems to matter the most when it comes to deciding whether or not they want to have an acquirer manage the merchant relationship versus them managing everything for them. So we try to listen really hard to our customers or our clients to find out, is that an issue for them, or are they comfortable allowing another partner to manage their payments on their behalf? That's probably one of the biggest noticeable differences between ISVs and payment facilitation, is that control issue.
Right, and it's very important to have that control at the end of the day. Okay, so next, Caroline. So what is the difference between the models of ISV, payment facilitator, and marketplaces?
Well, they're blurring, there's no doubt about it. There was a time when online onboarding was really only just available to payment facilitation, but there's a lot of really great super ISOs who are now making that capability available for ISVs. And ISV certainly is one that wants to focus on their software, needs to enable payments, wants to monetize payments, but maybe doesn't want to take on the full obligations, responsibilities, and regulatory requirements of payment facilitation. So as I mentioned before, one of the things that we do is really disclose everything that a tech company is going to need to take on all the operations aspects of payment facilitation, and then decide whether or not, in fact, they could negotiate with their acquirer and remain an ISV and turn over some of those obligations to the acquirer. So, and I know, Ryan, you have this conversation with clients all the time. Where is that slide to where you finally hear them say enough about, well, we want more revenue and we need to control everything about our customer relationship, and we don't want there to be any question about who they call for chargebacks and when is their remittance coming. And those are the kinds of things that we listen to really carefully. But I think finally I'm going to say that one of the things that matters the most is the remittance of funds. If you have really complex remittance requirements, then payment facilitation through the use of an acquirer that has strong instructional-based funding technologies, then you're probably better off to go to payment facilitation instead of ISVs. Ryan, you having any thoughts about that as you encounter that same question?
Yeah, so I think this is really, it's a lot of times based on that ISV's experience with their existing acquiring partner. You know, in most cases, that's a referral relationship where, you know, I love the term, I've got a guy, and they send the business to this merchant provider. And this is where, you know, the benefit of payment facilitation compared to that ISV payments partnership, where, you know, payment facilitation, you're able to control the customer experience. That ISV relationship with the payments company, you're handing off your client to another entity and you lose that control. And so I'll find, you know, ISVs where they've had really good experiences with their payments partner, their acquiring partner, and they're fine with it. You know, they know they're really good at their software that they've developed, and they don't want to get into payments. But I've found others, you know, I think this is more often than not, where those ISVs had a poor experience with their merchant acquiring partner, and they want to take that in-house because it's disrupting their client base that they work so hard to get, and want to maintain that client base and not have a high attrition rate.
I think there's one other comment I want to add, and that is to do with the ownership of the merchant contract. We hear so many different thoughts about this subject, all the way from some tech firms who say, I don't care about the ownership of the merchant contract because I own the merchant relationship and therefore I can move them to wherever I need to. But it's not that easy to get that merchant moved, and attrition is high and has always been high for the 30+ years that I've been involved with it. So if we hear we really need to own that merchant contract, then I think payment facilitation is the model.
Mm.
I want to comment real quick on that, because I think it's amazing. You know, I'll talk to payments companies and whatever flavor they're in, they're processing billions of dollars. Recently I had one that's about $4 billion in volume, and they felt like they could just port over all their existing merchants. Well, to Caroline's point, they don't own the merchant accounts, so they can't port them over. So it's not as easy. Like a lot of the technology companies, they don't understand, you know, the ins and outs of that, the ownership piece, and I think that is so important.
And so leading into the next question, Caroline, it's interesting because I think one thing you could touch on is there's that risk component that seems to get overlooked. It's a really strong consideration. So when you're evaluating key performance indicators with current or prospective ISVs or PFs or marketplaces, what have you, how do you help the client weigh those options in terms of which models they're better suited for, and their company would be, more importantly, whether or not it's a proper strategy for their business? So, I mean, how do you guide them along to say, this is a good idea, or maybe you should think about this for a while?
Yeah, it's a subject that we have early and often. I think I must have had hundreds of conversations with prospective ISVs and payment facilitators who, for the most part, actually believe that their transactions are without risk, that they just don't have concerns. And that's not true. Now, there are some sectors and some verticals that have low risk, parking, vending. You're not so inclined to charge back a $1.47 transaction for a Coke that you purchased. But there's risk in every transaction. And only during COVID have we started to have tech firms say, you know what, you are right. There are more risks here than we anticipated. So how do we manage those? And can we do so effectively enough to offset the potential for harm against our company? So a big difference between a single transaction risk, which can be managed through activity triggers and reporting, etc. And there's some great technology firms out there that can help you. But how do you manage against a merchant that's could go bankrupt because of something that was not seen, like the pandemic? So everything has to come together with a real strong, fruitful conversation that executives and employees together recognize where their risks are, and are open to talking about them. And then you can actually put in plans and technologies and processes to mitigate that risk. But to go in and saying, we don't have any, this doesn't apply to us, just is not a part of the payments experience, at least for everything that I've ever known.
Thank you, Caroline. So anybody like to comment? Austin, Ryan?
Yeah, no, I think I agree with Caroline. There's obviously COVID has brought about an eye-opening of a whole bunch of new risk scenarios that were, otherwise kind of swept under the rug or not taken seriously. And so, I think from our perspective as a payment facilitator and as a partner to lots of small businesses, we're able to have the unique ability to go in and sit down with our customer base and walk them through these types of possible risks. And I think that's been helpful in terms of us educating our client base and just reinforcing the value that we bring to the table in terms of being a payment facilitator relative to the customer experience. And as Ryan mentioned, when you have a problem, and someone comes to you, you don't want to have to be able to tell them, well, let me make about 10 phone calls and I'll get back to you, right? So we want to have that relationship with our customer base so that we are fully involved and showing that we're willing to do whatever is necessary to help them operate their business in real time.
Fantastic.
Yeah, totally agree with both Austin and Caroline. The other area to look at too is how much control the payments company wants to take on. building out a payments company, whether you're operating as an ISV, payment facilitator, or marketplace, there's a lot that goes into it. I think a lot of tech companies don't really understand the complexities behind it. That's where Caroline comes in from a consulting side, or Austin or Bruce's companies help from a platform. Obviously, Wells, we are here for the acquiring piece, but there's a lot that goes into standing up a payments company that a lot of tech companies don't really understand, I think.
Yeah, a lot of rules, regulations, and new ground that a lot of people have never thought about. So Ryan, from an acquirer sponsored bank perspective, what makes an ideal payment facilitator? I mean, what do you look for?
Yeah, there's a lot of things that we look for or look at really when we evaluate the potential partners that we have from a payment facilitator, ISO, marketplace side. One, if they're not already a payment facilitator, why do they want to become a payment facilitator? I think that's one of the first questions we ask. Are they just looking for increased revenue? I mentioned earlier, consumers and merchants are willing to pay more for a simplified experience, so there's higher margin there. Other areas that we see is company valuation, as bringing on the payment side internally, that adds value to the company particularly. And lastly, and this is something I've touched on multiple times already, is the customer experience. Pre-COVID or pre-payment facilitator world, pre-2009 and even post-2009, where ISVs would partner with the payments company, they lose control of that merchant experience. That client that they've earned and worked so hard to get, everything from the sales process for merchant to merchant underwriting, billing, customer service, the list goes on and on. In my opinion, again, this is the most important reason to become a payment facilitator, is that customer control. It creates a stickiness for the payment facilitator, and ultimately it creates a better customer experience for the merchant. And quite frankly, it's a differentiator. You look at all your competitors and whatever vertical you are, whether it's property management software, higher education, whatever it might be, this payment is one added feature or functionality that you're able to provide, and it adds the piece of this merchant functionality isn't a commodity. It's truly part of your software and something that you're able to provide. We look for a balance between those three for the why side. Secondly, we look at the what. What solution is the technology company actually providing? We want a technology company that's really providing a unique solution that has a long-standing solution that are truly helping merchants and ultimately cardholders. You look at vertically focused, we see these areas, these tech companies be the most successful payment facilitators, because again, payments is just a bolt-on or an add-on to their core functionality. Again, property management, gym management software, so on and so forth. Caroline mentioned that this is extremely important. This is the other of the what that we look at as the risk. So COVID has brought out a whole new definition to risk for merchant accounts. It's not really funny, but we look at member management, for example. Unfortunately, I know my gym has been closed since March. A lot of these gyms are independently owned, so the merchant themselves are struggling, but the software companies behind those gyms are struggling because a lot of them generate all of their revenue associated with transactions, and having those gyms closed since March, there's no revenue. On top of that, you've got the chargeback risk. So the gyms that go out of business, that payment facilitator in most cases will take on the risk of those chargebacks. So it's a lot of things to think about when you're evaluating becoming a payment facilitator. So we looked at the who and the why, and lastly, and this is I think the most important area that we look at, is the existing infrastructure of the technology company. And we really take a three-legged stool approach to this section. We look at the financial strength of that organization. Can they, facilitate being that payment facilitator? Do they have the proper credit and risk controls in place? OFAC screening, KYC. And lastly, the third leg of the stool is, the experienced staff. And this is an area where I think, again, technology companies don't think about this piece. If you talk to our head of risk oversight, he would tell you that you don't want your barber working on your car. It's the same way for, the merchant world. You don't want inexperienced people operating your payments business. Everything from underwriting to risk, card brand compliance, merchant support. There's so many areas that one stool of the leg could break. Long story short, valuing all those gaps can be filled, whether it's through Pay.com or Caroline's team or Bruce's team. Wells Fargo, we help identify these gaps through the onboarding process. We go through a fairly extensive process to evaluate an organization and point these out. So it's something that, again, there's a lot that goes into becoming a payment facilitator, but I think it's something that most tech companies should definitely evaluate.
Okay, thank you. So the inverse of that question. So what should an ISV or payment facilitator look for in a long-term acquiring sponsored bank partner? So they need to think about who's the best, what banks are best suited for them.
Yeah, definitely. And that's where you want a partner that can scale with you. We talk to tech companies all the time that are, increasing 50% year over year. It's not uncommon to see a tech company from a payment side increasing 100, 200% year over year. You don't want to worry about your partner not being able to scale with you and really outgrowing your partner. And unfortunately, we see that a lot. You go from $100 million to $4 billion in card volume in 3 years. Can your partner provide those services to you? The full life cycle. So you want to look at long term, and this is something again I mention all the time. Is look long term, don't look short term. A lot of these tech companies grow extremely quickly because there are so many various flavors. You look at the ISVs where they're partnering. You look at the entities where they want to become a payment facilitator, but they don't want to own the entire process. And then you go into the payment facilitators that do own the entire process, that's actually a true payment facilitator. And then ultimately, true sponsorship. You can look at partners like Wells Fargo where we can offer that life cycle to where if you get to the point where you want that BIN relationship and really control everything, have that direct connection to the card networks, we could support that. So that long-term aspect. Another area is the data. I think this gets overlooked too, where who controls that data aspect, how many times has been manipulated by the time it gets to your systems. That's an area where again it's something it seems so small, but it's extremely important. And then how does your partner reduce your risk? Where, and I think this is both from the consulting side, on Wells' side, or if you hire, Caroline or someone else, how do you look at that risk aspect and how can your partner help you minimize risk? Because if you're able to identify something early on, whether it's an operational risk or a transactional risk, that can be very costly in the future if it's not identified. So you want to look for partners that can help with that. With Wells, we do, again, it's a fairly extensive onboarding process, but we go through, really a full day of, reviewing an entity of what their policy procedures are, how they operate internally, to try to help identify those areas. And then I think lastly is, can your partner help anywhere outside of, the basic acquiring services? Obviously, Wells is a large financial institution. We're a large acquiring bank, sponsored bank. We're able to provide services outside of just that, just the acquiring piece. Everything from working with one of our bankers for a credit facility, or working with one of our teams from our accelerator program that offers investment into early stage tech companies. Bottom line, look long term. It's not a simple and easy fast path. And easy and fast isn't necessarily the best solution.
Ryan, I want to add one more comment to that, and that has to do with, does the principal member that you're talking to, the acquirer, do they have a program specifically for payment facilitation? There's lots of principal members out there, and there's a number of different financial institutions who have looked at the model and have pulled back away from it and said it just doesn't suit them. They don't have the infrastructure in place to manage them. So you really want to look at an acquirer that understands the model.
100% agree, and that's the scale. You know, you look at that partner that's able to scale with you. If they haven't done this before, that acquiring bank or that sponsor bank hasn't done this before, you know, I'd question, you know, the longevity of that relationship. You have, you know, a pandemic. I know this is something that doesn't happen usually, but this has brought up a lot of risks that are associated. A lot of sponsor banks or acquiring banks could say, hey, this isn't for us, and exiting the relationship.
Hey, Ryan, we got a question that came in that was directed to you. Ryan, how much does the regulated FI get involved in the KYC for merchants in the PayFacs portfolio deeply, or do you count on the PayFac to do that completely? And then there's a couple of follow-ons to that question.
Yeah, so and this is where you look at your partner. Like, there's a lot of different models when you look at payment facilitation. Wells' stance is we look for a payment facilitator ISO that really owns the entire experience. We will evaluate the payment facilitator ISO's infrastructure, their policy procedures, their KYC, their OFAC, of how you are monitoring the regulator side to each of the individual merchants. This is, again, something where it's extremely important and could get overlooked to where these tech companies where they're wanting to get into payment facilitation where they really overlook it. But to answer your question, we rely on the payment facilitator to monitor those on behalf of us.
Okay, so here's an interesting one relative to the pandemic, and you both touched on it, Caroline, in particular. But with the advent of COVID, do you all see? With the advent of COVID, do you all foresee more scrutiny from the card brands and acquirers around compliance and risk? And the add-on question that was, especially with the higher risk merchants.
You bet. I also want to say not only is the scrutiny higher, but the reserve requirements are higher. For the first 13 years of our business, we rarely saw reserves, and now 100% of the projects that we're seeing have reserve requirements. It's a big change with the pandemic.
Okay, well. Go ahead. You just go ahead and wind this up. We're about 3 minutes over, and we need to conclude this.
Go ahead. Ask my question.
No, go ahead and say what you're going to say, and we'll leave it at that.
Well, I was just going to say, yeah, with COVID, there has been so much that, you know, our risk and credit teams are monitoring existing clients and definitely looking at prospects in a much different way.
Yeah, I can imagine. So, Austin, Caroline, Ryan, thank you very much for your time today, and all the participants in the audience that decided to listen to this esteemed panel. So thank you very much, everyone, and look forward to hopefully seeing everybody back on the street and flying and having dinner again.
Sounds good, Bruce.
Thanks for
Can't wait.